Welcome back. The SGX Nifty is beginning to recover, now down only about 28 points. Ashwani Gujral, Sudarshan Sukhani and Mitesh Thakkar now join us. Good morning. Ashwani, we had that sharp bounce in second half yesterday. This morning, if we have a 20-25 point dip, would that be a buying opportunity or would you look at a bigger dip to buy?
Well, good morning. I would look for a dip to buy, but that does not mean dip at 920. Yesterday a lot of people took positions home. They're in trouble today. So my sense is that if I can get some kind of range-bound action and then second half rally, that would be much more preferable because you had a fairly strong rally yesterday. So the dip may not end too easily, although the market is strong, etc., etc. But I would like to see a few other markets recover before I jump in whole hog. Broadly, 11,700 is that place where I want to buy the dip, so that even if we just about recover, I'm in the money.
Okay, fair point. What about the Nifty Bank? What would your contours be?
See, again, very similar, it had a big 400-point rally. If it gives back, say, 150, 200, that is the kind of dip you want to buy into. But, banks are more positive on because the Nifty, IT banks can even go against each other. So today you have to take one clear trade, which should be to buy on the banks, because that possibly globally does not get as impacted.
Yeah.
Okay, well, Sudarshan Sukhani and Mitesh Thakkar are also with us. Gentlemen, morning to both of you. Mitesh, what's your view on the index? How do you approach it today after that big move we saw on the upside yesterday?
Good morning, Sonia. So I think again is nothing much. If you just look at the way the Nifty is moving, it's broadly tested the 11,550 mark from the lower end, rebounded, headed nearly towards the upper end of the range. I think this range-bound movement will continue, and I don't think we still have a signal of a breakout on the upside, though eventually I suspect the breakout will be on the upside. So with that sense, I think we are trying to buy every time the market is close to or below 11,600, 11,570 being the preferred range, and try to sell closer to 11,700. I think this 200-point consolidation might last for 4 or 5 days before we start breaking on the upside.
Okay, fair enough. Sudarshan, good morning. Your thoughts on the index? Yesterday we were making the point that if previous day's low was defended, that would create an intraday long trade. That played out, but positionally, what's the trade now?
Yeah, good morning, Anuj. Yes, it's that played out because the Nifty is in a trading range. It's very clear and visible. So 11,550 is support and 750 is resistance. Now inside this, essentially you buy the weakness, a dip towards 550 and try to exit and sell short a rally towards 750. It's not as easy as it sounds, but this is the only trade. A much bigger trade will come when these boundaries break, and they will on either side. We don't know which one, but they will. Inside this trading range, the market is giving some signs of relative strength. It's just relative. So for today, a dip is a buying opportunity. I cannot define a dip, but I can explain that 11,600 should be your stop. So you can calculate your risk and say, okay, I can buy at this point particularly. And any rally will allow you to exit. Don't carry positions. Okay. But the bigger trade has to wait.
Okay, fair point. Let us now look at individual stocks. Mitesh, your list is replete with auto stocks.
That's right. In fact, I've got about 3 of them today. Bajaj Auto, the intraday charts kind of improved dramatically yesterday. I think there should be some upward traction, and I would look at targets close to about 3,000. That's a buy with a stop at 2888. Maruti, we've been positive for last few days in Maruti. In fact, the first targets have been met. I think now it's heading towards the next target of 7320, and that's a buy with a stop at 7160. I also have a buy on Tata Motors DVR with a stop at 96 for targets of 106, and the solitary sell call is Max Financials. Keep a stop at 432. Look for declines to levels of around 409.
Okay. Ashwani, what's on your list?
Yeah, I'm sticking to banks, and if you get declines, they should be accumulated. So Bank of India is a buy with a stop of 100, target of 106. Yes Bank is a buy with a stop of 265, target of 280. BOB is a buy with a stop of 129, target of 137. ICICI Bank is a buy with a stop of 393, target of 410. And Canara Bank is a buy with a stop of 282, target of 296.
Okay, so a lot of buys there.
To banks and how?
A lot of buys in the banking space there. Sudarshan, what about you? What would be on your buy and sell list today?
Well, it's buying and selling both, because inside a trading range, the markets really are unpredictable. So starting with the selling, MCX is a short sell. That big rally in MCX is now fizzling out, and I would assume that it will go back to its earlier lows. It's a very underperforming stock. NMDC is a short. While we did see a rally in metal stocks, NMDC did not participate. That means that any decline anywhere, and that could include today, we'll see it go much lower. There are three buy ideas. One is M&M, which is bottoming out. It's a positional trade. It's also a trade for today. You want to buy it. Divi's Lab, which is outperforming. It's at the top of its chart, but I think there's more momentum on the upside. And after a long time, United Spirits. United Spirits, remember, has split. United Spirits is a buying opportunity. It's now in a trading range, and in a choppy market, a lot of these stocks go up.
Okay, fair point. Just wanted to add a little bit on NBFCs. Any of them you would want to buy, because you've all banks, Ashwini. None of the NBFCs, in particular, any trade on India Bulls? Housing, I mean.
See, India Bulls housing 780, 800. That's a good level to buy into. But if, large banks are giving you good straightforward moves, why you want to mess around with NBFCs and, news denied and X news has come and Y has come. Bajaj Finance, etc., that you can buy anytime. L&T Finance you can buy anytime. But try to avoid those, lower rung types.
Okay, well, gentlemen, we'll come back to you for more on individual stocks, on technical ideas. But now to a topic which is of real interest to retail investors. There was some buzz created last evening that one of the Kotak fixed maturity plans, or the FMPs as we call it, that is the Series 183, which matures today, will not be returning the full money to investors. We've spoken to the team at Kotak Mutual Fund and have gathered that the principal in this particular FMP and the others which have matured before this will be given back in full. So your capital comes back. The returns, though, will be given X of the AMC's exposure to the Z group. So in the case of this Series 183 FMP, which matures today, the figure stands at just about 17 to 18%. We have, in fact, two guests joining us. Manoj Nagpal, the MD and CEO of Outlook Asia Capital, and Amandeep Chopra, the Group President and Head of Fixed Income of UTIMF. Three guests joining us. Anant Narayan, money market expert, also joining in. Gentlemen, thanks so much for joining in. Anant, I want to start with you. What are your thoughts on this issue? The fact that, the full money will not be coming back to investors. And it's a scary thought about whether this sparks a trend of AMCs giving a full pass-through of the losses to investors, as opposed to earlier when, the losses would be subsidized or subsumed by the AMCs itself.
Good morning, Sonia. I must admit, I don't know about the specific Kotak FMP. I'm sure your information is right, but I haven't had first-hand information of it. But to your broader question, look, AMCs are pass-through vehicles. They do not take on risk on their own. And to expect that AMCs will bail out investors at all points of time is something that we should disabuse ourselves of. The risks are squarely with us as investors. Now, even if there is a delay in payment from the FMP, I would strongly suggest that there is no reason for panic. Bulk of the papers held in debt mutual funds or in any kind of debt instruments held by mutual funds is reasonably safe. And this is an aberration, I guess, which will get sorted out soon. I also think SEBI is doing a lot of work in trying to ensure better governance, better mark-to-market processes, and protecting small investors. At the same time, clearly there are lessons for people in the ecosystem to take. Secondary market volumes in corporate paper is extremely small in comparison to the size of the mutual fund AUMs. And clearly that's something that both regulators and market participants have to address.
Okay.
And also, I guess funds have been guilty of relying too much on ratings rather than doing their own analysis. So whether it's better credit systems, better disclosures, better governance, the ecosystem has a long way to go, and I'm sure we'll go there.
Okay. Amandeep, what is your sense now? This is only the first of the FMPs which are returning money. Will this be the trend? Because there are the entire lot of ILNFS and its babies which are held by various funds. So has the rule been set? Now we should start seeing people either returning less principal itself in some cases like ILNFS, or at least saying that we are withholding.
Good morning, Lata. There's a couple of observations and points on this issue. Firstly, at the time of launch of any fixed maturity plan, there is a scheme information document which is released, which broadly lays out the rating profile that the fund will have. So as long as the investment was done within that specific, rating profile and allocation, it's a perfectly legitimate investment. So I think that's the first starting point as far as fixed maturity plans.
Amandeep, I have to interrupt. Secondly, obviously, in this case, the downgrade came in between for papers like ILNFS. And in Z, when they had to come to an understanding with the promoter that the shares, the underlying security will not be sold off. So this is something which happened in the process when the FMP was already, was already formed. And therefore, how do you treat it? I mean, first of all, is it in compliance with SEBI rules? And more importantly, I want to know if the rule has been set now for other funds.
Surely. So, I would assume that it is in compliance with SEBI norms because, as it's not a question of not returning the capital or money back to the investors. It's a more issue of how you're valuing that particular security. So if you've actually written down the entire security to zero because of, default, then clearly you are essentially returning only the residual amount that is attributable to the investor. Now, typically, whenever you are valuing these securities at zero, there is a provision which allows you to hold on and, work towards recovery. And whether the recovery comes in 1 year or 2 years, there is, in a way, automatic side pocketing of this investment because the proceeds, if there is any recovery, will go directly to the investors who are original investors in the fixed maturity plan. So the question to be asked is, it's not a unilateral decision of the fund house to hold back investments. If they are valuing this particular security at zero because of a default cross, so whether it's an investment in ITNL or any other such entity, I'm assuming that it is already being valued at zero because there's been a default on the deemed date of maturity. So from that perspective, it's perfectly legitimate and in compliance with the SEBI norms. And coming thirdly to your final point, whether this will be
the trend.
I would think so, because like Anand mentioned, I'm quite surprised at the earlier instances where mutual funds subsidized their
investors.
That is not really the norm or sort of a common practice for mutual funds because it's a pass-through investments, and you essentially have to give the risk of both upside and downside to the investors.
Sure. Manoj Nagpal is also with us. Manoj, should wealth management firms exercise further due diligence in selling these products to, customers or retail investors? And how do you see, how can investors safeguard themselves in future?
Yeah, so what has really happened in this case is that these are really known as high-yield FMPs, which are sold by, wealth management firms. So in this particular case of the FMP of Kotak, which is 187, which is maturing today, a bulk of the sales were done to the Kotak Bank wealth management clients itself. And the Kotak wealth management firm, in our view, should have taken due diligence and due safeguards and regular communication to clients. This was a known problem. Sometime back when, in January...
Manoj, the line isn't very clear. I think we'll put you on a phone call in just a second. Amandeep, I want to know if now debt investors will be scared away. Are we going to see either redemption or at least stoppage of further flows? Even launch of debt funds, will that also be constrained?
See, Lata, I must highlight that in the case that you have mentioned, it is a perceived loss. It is not a realized loss yet. So if there is a resolution and you actually do recover, part of your investments through whatever resolution that takes place with, any of these groups, then clearly, that money will come back to those investors.
That's fine,
So
but there will be a lot of
yeah.
retirees who would have put money in such a way that they will get money at a certain date. So,
Right.
how is the lay investor likely to react?
So I think we already are seeing signs of that in terms of, relative flight to safety. In fact, most of the fixed maturity plans which were launched in the Jan to March period were largely built around very high investment grade, issuers. So these were typically the AAA quasi-sovereign issuers, including even, state government loans and so on. So I think we already are seeing some of, sort of fallout of what happened in the last quarter of last, calendar into the behavior of investors. But are FMPs with weaker credit quality going to be sort of preferred right now? I don't think so.
No. Oh, that's the important point, right? Manoj Nagpal, I think, is back with us. Manoj, what's your own view? Do you think investors will stay away from future investments into some of these FMPs?
I surely think so that, with this episode happening and mutual funds deciding to, delay the payments is going to create a scar on investors. Investors assume that all FMPs, and this is for the first time that the mutual fund is delaying the, proceeds of a maturity payment. And it was, in our view, a written contract between the investor and the mutual fund that the monies will be paid out on this date. Whereas the mutual funds have now gone ahead and, done an unwritten contract with the issuer saying that they will hold on till the, for the next 6 months, giving, time to the issuer to salvage the monies. So in spite of having a known problem in hand, not communicating effectively to the investors and not coming out with a resolution on the defined dates, these maturity dates are defined for all investors. And no investor till the last 2-3 days was given any indication by any of the mutual funds that they will be delaying this payment to them. So I think this really raises a concern of how the mutual funds have handled this entire issue.
Okay. I'm just wondering if there is a debt market issue in the sense not much money will come. I'll tell you my personal reaction. Amandeep, I know of a family member who wanted to plan for retirement, and he was looking at various debt funds to get a return. And I told him, no, stay off, just go to gilt funds. Will that be, it's a very lay response. It's a very panicky response. But will that be the response? And therefore, are companies going to get less money from the debt market altogether?
Lata, I guess to some extent, what Manoj mentioned is true. There is obviously going to be a bit of knee-jerk fear among investors. But again, one of the learnings from such events is that firstly, there'll be more due diligence on the underlying portfolio. So I guess investors will clearly aim for fixed maturity plans with a certain defined, sort of rating profile or known names where there is adequate comfort even in the present, environment. And secondly, investors who do aim for higher yielding FMPs where there is an element of, lower rated exposures, I think they will now clearly have to build in some degree of, write down or losses in case the credit turns down. So I think that is what I think will happen. The basic, importance or nature of a fixed maturity plan is still quite attractive for investors. So, I don't think that will really go away with this event. But like we have seen with, some of the other, fund categories, whether it's in the liquid funds or ultra short-term funds post-ILNFS event, those categories have still grown. I mean, people have simply rejigged their portfolios, have, changed their risk profiles and then moved accordingly.
Fair point. Amandeep, thank you very much. Anant and Manoj as well for joining in this conversation. I think the important takeaway that has come from the guests is that both investors and funds have matured. I mean, after all, the liquid funds went through the problem and afterwards people once again started putting their money in. So maybe it will not be a longer term problem. Maybe it's a maturing process.
But I also think the biggest takeaway for me as an investor was that there was no intimation given, to the investors that this kind of a delay in payment would take place. So it's the first time something like this has been done. I guess there's no precedent to this, which is a bit disconcerting.